Hello, good afternoon, everyone. Uh, uh, Hi. Thank you all for joining us for this latest edition of our Chai session. We at Pi Ventures are super excited to have you all here. And we were pleasantly surprised by the fantastic response to the event. So, thank you all for making out the time on a Saturday to join us. We have a very diverse set of people attending the event. We have a bunch of deep tech entrepreneurs, some budding entrepreneurs, people working in R&D and business roles in large organizations. We even have some consultants from big bulge firms, some angel investors, and even a few VCs themselves. So we look forward to the diverse set of questions and viewpoints each of you will bring to the session, and we hope to make it relevant for all of you. A quick introduction about Pi Ventures. So we are a deep tech and AI focused fund. We started investing in 2017. We are a $35 million fund. We like to be the first institutional check into the firm. And our average first check size is plus minus $1 million. And we can invest in subsequent rounds. So today we will be diving into the nuts and bolts of building an investment thesis. And we will showcase this process using an actual example. The example that we picked today is warehouse automation and the use of artificial intelligence in that space. Just a few ground rules to make the session more efficient and productive. So during the session, we will be taking up questions, but we will be picking up those questions from the Q&A tab on your screen. So please feel free to put in your questions there. Please refrain from using the general chat unless there is an issue to avoid a lot of complexity. And we will also be reserving time at the end for an interactive Q&A session in case there are any general questions. And then we will talk about the fellowship opportunity at Pi Ventures. Before we dive into the session, I would like to invite my colleague Roopan to give you a brief introduction about her. Roopan, on to you.
Thanks, Shubham. Thanks, Shubham. Good afternoon, everyone. Thanks so much for joining us. We are very happy and excited with this great response. So about me, I'm Roopan. I am an MD at Pi Ventures. I look at investments, look at leading deals, evaluating deals, and also the closure bit. And I oversee a couple of boards here. Been with Pi for 2.5 years now, and I have overall around 15 years of experience, most of which has been on the tech side, as well as in deep tech investments. So that's in brief about me.
Thank you, Roopan. Yeah, Roopan is one of our resident experts on robotics, and then we're glad to have her to speak about it. Quick intro about myself. I joined Pi about 3 months back. My background has mostly been on the investment banking side, and as a former entrepreneur, where I was running my own rooftop solar startup, which I exited. My last gig has been in Amsterdam, where I was working on a deep tech startup, which is working on extracting carbon dioxide from air to mitigate climate change. Uh, I'm also an angel investor and a mentor with Techstars, and glad to be able to speak to you all. So, with that being said, I will now dive into the session, and yep. Uh, Sure. So is my screen visible, Roopan?
Yeah. Yeah.
Perfect. So yeah, so why are we building an investment thesis, or what's the need to build an investment thesis? There is one and only one reason why an investor builds an investment thesis. That is to identify investment opportunity. Everything else is the why and the how of doing it. But the primary reason is why do you that to identify investment opportunities. And for an early stage fund like us, it is imperative for us to get in early into the trends, which can become big in the next 5 to 10 years. So we are trying to gaze into the future and predict how the future is going to look like. There are two broad approaches that investors follow in identifying startups in general. The one that we'll be talking about today is the top-down approach, where we pick a market, we build a thesis by doing internal analysis, and then we identify promising startups using that analysis to go out and speak to them. The other way is where you come across an interesting startup. You probably get to meet them at an event, or they reach out to you. You like what they're building, and then you take the bottom up approach of analyzing the company, the market, the competitors, and other stuff all around it. So the top down approach gives you much better understanding and insight of the market when you are actually going out and meeting startups. So now that we've identified why we build an investment thesis, which is to identify the great investment opportunities that might exist in the space. So what questions are we trying to address? Uh, there are a bunch of questions. Again, these are not exhaustive. There might be some others which might be pertinent to a specific space, but these are definitely the questions that you want to have an understanding on. The first and foremost is the market opportunity big enough? For most investors, in especially institutional VC funds, the market has to be big enough so that the startup itself can become great enough. So a small but growing market is something that an investor might look at, but a large but changing market is something that an investor might be really excited about. Why now? What makes it the right conditions to be able to for some of the early stage startups to be able to grow into large corporates over the next few years? So what are the market drivers that are driving some of these trends that would make it a good time to invest in the space? Then we get into the nuts and bolts of mapping the space, and then we will discuss this how we did that for warehouse automation, which is effectively you breaking down the larger market into smaller sub markets, and then analyzing each of those to identify where do you want to invest your time, resources, and eventually money in the ecosystem. For each of the sub-markets that you've identified, what are the addressable problems? So each sub-sector or sub-market will have different challenges, will have different opportunities. And what are those challenges that you can address or a startup can address using the existing technology available? What are the existing technologies in use? So because you are going after markets that are already sort of in play, most incumbents will be using some existing technologies. So it is a good idea to identify the existing technologies and then the gaps in those technologies, and that is how you find the white space to build a really large startup. So it is important for not just an investor but also for an entrepreneur to do a mapping of the existing technologies and why they are lacking. Once you've done these initial bits, you should have a fair understanding of what will it take to for a startup to win in the space. It could be the technology moat itself. It could be the GTM strategy. It could be the market insights that the founding team will bring to the table if it is a very highly complex market like biotech or some other spaces. So what are the winning attributes that you would look for in a startup, in a founder in the space? uh, how do we identify the most attractive segments? Once you've done this, the once you've identified the winning attributes, some of those might be already heavily funded with a lot of incumbents. Some of them might still be a few years away from actual commercialization of the technology. So here is where we step in and actually predict or try and predict what's going to happen in the next 4 to 5 years, and so that we can get in early into that segment. The last two parts are mostly trying to do a mapping of the global startup landscape. You want to be aware of what other startups are building in the space, what are the other players who've been funded, especially the heavily funded ones. Would is the startup or is the space that you're looking for, does it have any space for a new player to come in and build a large business? And then finally, the goal of the thesis should be to identify a few startups in your chosen segment that you want to go and speak to in greater depth and detail, and to actually figure out whether they take all the winning attributes of a startup in the space. Uh, yeah. So any questions? Sorry, I couldn't see any questions.
Shubham, there's a
Uh,
question.
sure. Yeah. Okay. Sorry, where's the question?
It's in the questions icon.
Yeah,
Shubham,
sorry.
there's a button before the.
Yeah, 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 yeah. Sorry. Um, so what does market opportunity big enough mean? Great question. So thumb rule is it has to be worth at least a few $100 million. It becomes super exciting if it's at least $1 billion market, or if it will reach $1 billion in the next 3 to 5 years. So if it's a few hundred million growing at about 20, 30, 40% annually, and you expect it to reach a billion or a couple of billion in the next few years, that's when, for an early stage VC, the market opportunity or the segment becomes attractive. Uh, if there are any, oh, so so you so we are all trying to predict the future. I think you will one can never actually say with 100% confidence that the timing will be right. That being said, by doing this whole analysis bit and by identifying the trends and the global market drivers, you can say with a reasonable confidence, within a reasonable confidence interval, of whether this is going to happen in the near term future. Again, the actual timing might vary by 12 to 24 months, and that is okay. That is the risk that most VCs are taking on when the market actually explodes. Um, uh, yeah. Sure. So some of these questions I will be walking through in the next few slides. Uh, and I will address one of those right now. But apart from that, I think some of the questions will be addressed in later on. So about the team, uh, it is so once when you are investing in the startup itself, the team becomes, I think it becomes the most important metric to judge on. This whole presentation or this whole session talks about on how to identify the most interesting startups, and then once you've identified those startups, you will obviously go and speak, or you will obviously go and speak to the team. You will try and understand their business model. You'll try and understand their margins at scale, and there are a whole bunch of other things that come into the picture, but that is more company specific. Today we are trying to address more of a top down approach in how to understand and analyze a market. uh, uh, sure. I think I see some of those questions, and I think some of those questions will get answered as we go around. And if they don't, then we will have a Q&A session at the end, where feel free to just ask those questions then. So sorry. So now we will try and answer all those questions that we discussed with an actual example. And then we've developed this example so that to give everyone a flavor on a more macro level on how to think about a space. There are again very specific specific questions about a market or about a team. That will not be addressed here, but those come in the second phase of analysis. Once you have uh, the interesting startups already identified. So we've taken warehouse automation, and so how did we get to that? So we believe that in today's world, especially with the COVID tailwind behind us, there will be greater automation in the world. This would be on account of people prefer more remote work. This will be on account of decreasing trend of people wanting to do physical labor. This will be on account of the fact that corporates want to reduce their operating cost, and in a lot of the businesses, labor costs are the biggest drivers. So we briefly broke down the robotic market segments into the top five segments that exist right now. Those, as you can see, are the manufacturing, logistics, healthcare, agriculture, and horizontal players, which mostly focus on developing software solutions for a lot of the hardware players. Then for our example, we did a quick market size. Again, this was a top down market size. We will talk about the two market sizing approaches in subsequent slides as well. We saw that we analyzed the top five markets. We realized that all of them are going to be fairly big in the future. Then we looked at the funding trend and how much funding has flowed in as compared to the market size. Uh, and then finally, I think we looked at the opportunities and challenges for each sector, and the key themes that would take on or would take off in that particular segment. So for example, in the logistics theme, in the logistics segment, we already know about the increased e-commerce adoption that's happening globally, the high labor turnover, and for more deep tech AI opportunities, we look for use cases where at least if there is a timeline to develop, if there is a large timeline to develop the technology themselves, there won't be enough resistance towards the adoption of the technology. And that we've seen play out very well in the logistics place, where most logistics players, because their margins are wafer thin and they require huge amount of labor, we've seen really quick adoption of robotics in the logistics space. We then we look at the broad challenges that this space will encounter. So one of the broad challenges of this space is the in-house development by large players. We already know Amazon develops its own robotics. Alibaba does that too. So you have the large players who already doing their upstream sort of building out an upstream robotics companies which plug and play into their own warehouses and logistics deliveries. So that's a major risk and a challenge that we see in the space. And the other major challenge that we see is that in the logistics space, because you cannot fully automate 100% of the entire process, you would need something known as cobots, which are basically collaborative robots which can work in an effective, safe manner with humans to have a productivity and efficiency increase, but not to have a detrimental impact on the safety concerns in the space. I will quickly go on to the next slide and then take some questions. So just quickly going on to how do we do identify the market opportunity. Uh, so there are two ways I spoke about on how we look at a market opportunity. The easy way and is for sanity check is more of a top down approach. You find reports, you go through the reports, and as we can see from and you will find different numbers in different reports. But as long as they're all big enough that and inspire you, give you confidence to dive deeper, that's what you're trying to do right now. Uh, so as we can see, the warehouse automation market worth 14 billion, expected to grow at 12%, reach about 27 billion in the next 5 years. The other thing is that almost 80% of the warehouses today are either entirely manual or have very low level of automation, which means that there is a lot of legroom for not just existing players to come in and grow, but also for new players to build products for the people who haven't actually upgraded their automation. Just a couple of macro trends as well that I've mentioned here. We could have multiple macro trends. I've just identified a couple of the key ones, which is that the e-commerce sales, also driven by COVID, they are increasing roughly at about 15 to 20% in the developed markets. Today, in this year, they will increase by about 30 odd percent. And the number of global warehouses using high level automation is expected to become tenfold, uh, roughly about 6,000 right now, roughly expected to become tenfold in the next 5 years, which gives you confidence that in a lot of the fragmented markets, warehouse markets, there is an opportunity for new players to come in. I will now quickly go on and identify
Shubham, I
some
think there
questions.
are a couple of questions that I've identified. So there's someone asking, how important is it for the investor to understand the technology?
Oh, I think that for a deep tech and AI fund, I think once you've identified, and Roopan will talk you through how we identify the interesting technologies in a particular space. But once you've identified the most promising startups, we actually spend a few hours just diving deep into their technology stacks and how they will scale up, how they differ from what is the existing competition in the market. So extremely important, I would say.
And there's another question. Do investors deviate from their thesis if the opportunity is?
Do investors deviate from their thesis? So I think it we as mentioned on the opening slide, I think investing is about two approaches where we're discussing the top-down approach. If we see an exciting opportunity, then that becomes a sort of a mashup between a top-down and bottom-up approach. Let's say we are looking at warehouse automation and we've identified a particular sort of segment within warehouse automation, but during our analysis with or speaking to companies, we come across some other company which is adjacent or but not exactly what we identified. We most definitely sort of speak to them. So this again gives you a flavor on how to go about in optimizing for your time, energy, and resources. But that being said, it doesn't negate any interesting startup that might exist in the space. Uh, any other questions, Akhilesh, or can I head back?
You can head back.
Okay, understood. Thanks. Uh, just sure. Yeah. So, and before I dive into this, actually, I would like to talk about the bottom-up approach to market sizing, which I think is more important for a VC investor. I think once you've read a bunch of reports and you have fair amount of confidence on the space, I think this becomes super critical, and we make it a point to actually use if at least a couple of approaches to arrive at a market size that we think more fairly reflects what is going to happen in the future or what is happening currently. And then here I talk about a market sizing approach that we use for the sorting robotics markets landscape within warehouse automation. So again, the warehouse automation itself can be split into multiple subsegments. We've picked a segment that we think is interesting, which is the sorting space. And now I will quickly just walk you through how we looked at how we analyze the market size for this. So we broke it down, and again, as the idea is to be as granular as possible while you're doing this, so that and at every given point of time, test your assumptions, which might change as we go along. So for this, I broke down the market landscape because we were looking at Indian startups. So I broke down the market landscape into annual e-commerce shipments in India, China, and
Shubham,
globally.
sorry
Yeah.
to interrupt you. Your Excel is not visible, at least not to me.
Oh, I will have to stop sharing and then probably share again. Yeah. Sorry about that. Uh,
Meanwhile, Rupan, I think we can answer another question from the audience. There's a question that a gentleman asked: since we are talking about early stage opportunities, isn't the team more important than the opportunity?
Yeah, so see, I think Shubham partly addressed this. So, what is important when we are doing the investment thesis is to understand what are the traits that a team should have to be able to make the venture successful in this specific, whichever sector you're looking at. But of course, when you're evaluating a startup, then the team becomes very important. But we can't ignore the market opportunity at the same time.
So just to add to that, I think a lot of this analysis that we're doing right now actually feeds into the question of what are you looking for in a team, because this would actually teach you, and then there's a slide on that on what are the winning attributes, and in that the winning attributes have to either be demonstrated by the team or they have to show a capability to grow into those roles, and so I think this becomes super important to for us to analyze and just benchmark different founding teams more effectively. Is my Excel now visible?
Yeah.
Perfect. Yeah. So sorry about that. So I was just talking about how try and make it as granular as possible. So what I did here was that I took the annual e-commerce shipments for India, for China, because China accounts for almost 50% of the annual e-commerce shipments, and global excluding China. I removed Amazon because for a sorting robotics company, Amazon is not going to be a customer. It might eventually end up being a buyer, but it will never be a customer because Amazon has its own internal robotics division. So we arrived at these were numbers again that were taken from various research reports. The annual e-commerce shipments, the hourly e-commerce shipments were again it's just dividing the number by 365 and 24. Uh, Typically, we spoke to a few key players in the market. We did our internal research. We arrived at that typically the number of sorts per shipment is roughly around somewhere between 2 and 2.5 per shipment. Here I've taken 2 sorts per shipment. Uh, and this this would give us the total number of sorts that would be happening on an hourly basis in a particular market if you multiply row 5 and row 6. uh, based on speaking to people, again speaking to mostly experts, what is the efficiency of sorting robots, and then again the numbers again vary. We obviously like to leave some buffer here. So
Just
we will
to
take.
interrupt for a quick second, could you please zoom in? I think there's a few people on chat who are.
Sorry, they want to zoom in.
Yeah,
They want
just
me
zoom
to
in a
zoom
little bit. I think.
in? Yeah. Is it better now? Yeah, sorry. Um, yeah, so row 5, row 6 gives us a number of sorts for a particular market in the e-commerce space. Row 7 is where we go and speak either to market experts or we do some internal analysis and identify what is the productivity of a particular robot in terms of number of sorts per robot per hour. We again use try and get different numbers and then probably take some sort of median for those. So for here, I have taken a median of 70 sorts per robot per hour. This gives us then the row 8 gives us a number of, at steady state, what will be the number of active sorting robots in a particular market. As you can see, the Indian market is pretty small and the China market is actually the largest. Uh, the row 9 actually, you will see we varied the numbers. Um, Here, I think one needs to sort of keep the macro picture involved. So in India, the labor or the wages cost that a robot will be replacing are lower. Hence, we've taken and this an average of wage worker would be earning somewhere around 20,000. So we've taken about $300 per month is would be what you'll be able to sell your robot as a service for. In the China, you can charge maybe a bit higher because the wages that you are replacing are higher. Whereas in most of the developed world, we've taken a 10,000 RAS price per annum, but you could actually even charge higher. Again, we try and be conservative here, so that even if we go wrong by being on the lower side of the spectrum rather than overestimating the market. Uh, by multiplying row 8 and row 9, you actually get a total market size for these sorting robots in the ecosystem. As you can see, the Indian market is pretty small, about $20 million. So what this tells us here is, and again to answer some of the questions that were raised, that a startup that's building, let's say, sorting robots for warehouses will have to expand globally for them to become a big player. In India, the market size is very small, which will bring us to our next sort of inference that their GTM strategy should be strong enough for them to expand globally, which means that the founding team itself, someone should have demonstrable experience of either selling internationally or having that hustle to be able to do more enterprise B2B sales, which will be larger ticket sizes and not smaller ticket sizes. So this market size has actually now given us insight into what we look for in a founding team. I hope that answers some of the questions that were raised. Uh, the, Again, the China and the global markets are fairly large, as we can see. So this gives us the total market size. We again take a buffer of the percentage adoption that's going to happen within the next 3 to 5 years, which gives us an addressable market size for a particular market. So as you can see, the total market size is upward of $1 billion. So for an investor, I think we are fairly, this would take our check boxes in the sense that this is a large market. Even if we look at the addressable market size, it comes out to be over $500 million, which as we can see with the increasing trend, we would expect that the addressable market would also hit $1 billion pretty soon. So the bottom up market sizing is extremely important for you to actually build confidence in the space rather than relying on external research and reports.
So
Shubham,
Shubham,
Yeah.
yeah, maybe I'm just asking on behalf of audience. It might be important to answer why are you looking for a big market size?
Okay. Yeah. Thanks for that, Manish. So we're looking for why are we looking for a big market size? So typically, I think fundamentally for an investor, the primary job is to invest and to grow the money, and to give returns to their investors. The growth in a market, the growth of a startup is somewhat correlated to the size of the market. There are very few markets, actually. There is absolutely, actually, apart from, let's say, Google and Facebook in digital advertising, there are very few markets with the with the network effects that exist, which means that most of the markets will be captured by multiple players. So, for example, let's take this example. Let's say that the market size is $1 billion. They're going to be 10 or 15 players, all let's say equally sized, which means that at steady state, a market would be doing a 50 to 75 million dollar in revenue, which means that it would hopefully be valued at somewhere about 500 million to more, depending on the revenue multiple for that particular space. So because it's important for us, for a startup to grow big, they can only become big if the market size is large enough. And the other point that I think we haven't touched upon it here is the fact that that most of the VCs will only have 2 or 3 successful investments out of maybe 10 that they make, which means that the 2 or 3 that are really successful need to become really big, and they can become really big only if the market opportunity supports them in becoming really big. So the market size is small, even if you capture 40-50%, the valuation of the company will not support a really huge market size.
So there
Rupal,
are
if
a
do you
couple
have,
of quick questions.
sure.
One was specific to the robotics Excel that you shared.
Sure.
How did you get the, someone wanted to know, how did you get the sorts per robot?
Sure, the sorts per robot. So yeah, so that's something, because and again, as VCs, you will never be experts in a space, which means you will have to go out and speak to people. So for this particular space, we actually reach out to a few people working in some of the largest e-commerce companies in the country. We are actually spoke to a few automation experts as well, and then we the a lot of the times, if you dig deep enough into the internet, you can find some research report that sort of mentions these numbers. And once you have numbers from 3 or 4 different sources that you feel confident about, we typically, if they're in the same ballpark, then it's fine. If they vary a lot, then we probably end up taking the median. But this sorts per robot was something that we get from experts to answer.
Shubham, so there was one more. Sorry, go on,
So
Rupa.
yeah. So just to wrap up the previous question, so in this case, when you're building a robot to do certain number of sorts, you have, as a benchmark, you need to take into consideration what if a human is doing the same function, what is the kind of throughput that they would have. So on a per hour basis, today, labor can do about 70 to, let's say, 80, 90 sorts per hour. So bare minimum for any company that you're looking at, the number of sorts should be 70, so that at least it's at par with the human. So that's also another benchmark that was looked at for this number.
Yeah. Uh, Akhilesh, any other questions, or
Yeah, so there
shall
was
I?
one more interesting question. Maybe we can take this one and then move on. For a breakthrough product for which a market doesn't exist, how do you calculate?
Uh, you can, I think, okay. So for a breakthrough product, I think the product and the technology might be breakthrough. Some form of market or industry already exists out there. So let's say, and I will take a simple example, just to when Google came in and said that I will drive digital advertising, the digital advertising space was did not exist, or was a few $1 million, but the advertising space in general was worth $1 billion. So you can find proxies, or you can estimate the market size by looking at adjacent spaces, or looking at a more macro level, doing a more macro level analysis to still come up with a market size with a reasonable amount of confidence.
If I can just add, Shubham,
Yeah.
here, there is sometimes a confusion on market size because it sort of is a number out there. Uh, Other way of looking at an estimate of how a company can become big is actually to do an estimate on how much revenue they can make. So that's a little bit of a bottom up estimate of the revenue potential of the startup. So typically, if a revenue potential of a startup is anywhere between 50 to $100 million within 4-5 years or 6 years, then that typically indicates a good growth and a good market size which can open up. So that's another proxy to use it.
Yeah. Uh, Okay. So I will go on to the presentation. Yeah. So once we've identified the market, and if we feel confidence about the market size itself and the opportunity that's available, we look at the major market forces that will drive the space in the future. So broadly, two: one are your tailwinds, one is the headwinds. We've labeled them as enablers and challenges here. So for this, and again, I think these would vary according to the space that you are sort of analyzing. And then I think here is where you have to do a lot of reading. You have to speak to a few people. You have to be confident that the enablers will 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 overpower the short-term or long-term challenges of the space. So for this particular sort of warehouse automation space, I'll just quickly go through some market enablers, and then would like to actually take questions on this rather than spending a lot of time on this slide. So the market enablers for this space is increased adoption of e-commerce. We spoke about COVID and the higher preference for automation. In the developed, there's a lack of trained labor, and the training expense is increasing. Um, the online retailers have wafer thin margins, which means that they want to lower the operating costs. Using automation, you can reduce not just your warehouse space, which is a pretty big function of their cost, but also the lower their labor costs, especially in developed nations where the wages have gone up by about 50% of the last 10 years. The other enablers were more on the technology side, that there's been a falling price of robotics. So there's been a 50% drop in robot prices versus 100% increase in wages since in the last 30 years, which means that there'll be a higher ROI for your eventual customers. Due to e-commerce, there is now a lot of variability in actual consumer demand. So most retailers now want a greater flexibility and modularity, which is very difficult to achieve with only humans, whereas robots can be programmed to give you that. uh, we will spend an actual entire slide on the technology bit in warehouse automation. Roopan will talk about this. So the just briefly mentioned a few: the advancements in computer vision, autonomous technology, computing power, and then finally, just there is a superior customer expectation where people expect shorter delivery times. People post negative reviews if there are shipping errors. Returns actually cost 5x more than for a retailer to ship than to ship back into and than to accept a return and to ship a new product, which means that they want to reduce the shipping errors as well. So these are the market enablers that we saw why a warehouse automation space itself will take off. What are some of the key challenges in the space? Uh, Robotics is generally a large capital investment. So only larger players can afford to make the investment, unless you go onto the robotics as a service model, which means that the business model of a startup itself will then become more capital inefficient because they will have to fund the initial investment into funding the hardware for their clients. COVID is a tail headwind as well, especially in a lot of the developing countries where high unemployment due to COVID could reduce labor costs, which might mean that retailers are resistant to deploying some of these solutions. Warehouse operators are also typically not very tech savvy. So for them to have the internal knowledge or expertise to maintain robotic fleet might also lead to an inferior experience, which might delay the adoption across other warehouses of the same player. Currently, we've also seen that each player in the market is making their own robots with their own software. So there is no, let's say, Android or Android ecosystem sort of equivalent where people can plug in their robotic systems which all talk to each other. So that could be a challenge in for a customer to manage different softwares and different robotic systems who don't talk to each other. We saw through the market sizing that the small market size in India, the business needs to be able to expand globally. If your robots break down, or if they don't, if they are unable to, let's say, carry on for the requisite number of hours at a stretch, it will have an adverse impact on ROI. We've discussed the in-house development by large players. And then the final challenge that we think could be that could be a headwind for the space is that there is a lot of variation in warehouse layouts and sizes, and especially if you're looking at making a lot of these things autonomous and adopting for a particular warehouse size, it could mean that the amount of data that you would need to collect to have an effective ROI for some sort of warehouses might not exist right now. I will take questions right now because I think that's more relevant here. Akhilesh, any specific questions that I should?
So there's a question in chat, right? And this gentleman asks, how important are strategic investments? If a portfolio company helps accelerate growth of a potential investment or vice versa, would that impact?
So if I understand the question right, it is that if, let's say, Flipkart came in and was investing in a robotics company, would it change my investment thesis?
No, I think it's more to do with the inter-portfolio company synergies.
Okay, inter-portfolio company synergy. Okay, understood. I think it is not, while building an investment thesis, I think we try and keep it independent of each other. Uh, if there are any synergies and overlaps that we obviously see, we are happy to sort of make the connections and actually help both the portfolio companies if things work out. But just because there might be a synergy, we do not that does not change the results that arrive from our investment thesis. Uh, any other questions, Akhilesh? Or
On balance, how would you decide if in this example, if challenges outweigh enable?
so I think there is no you can't put a number on it. So fundamentally, you cannot say put a number on each of these metrics that I've identified and say that x sum of x equals sum of is greater than sum of y. So I will invest. I think the market enablers have to be strong enough for you to be convinced that the trend will continue. The market is large enough and the trend will continue. The challenges have to uh, the challenges ensure that you don't have any blind spots with regards to the market, which means that when we actually dive deeper into the market, we will try and maybe, let's say, identify startups who've already solved some of those key challenges. Let's say a startup who's already has a customer in let's say UK. So for them, the expanding globally now is not such a big challenge because they've already demonstrated an ability to sort of do that. Let's say someone has already launched their robotics as a service model and they're already offering that service to their customer, which means that the large capital requirement is not a challenge for this particular startup. So I think this helps you just point out the blind spots that might exist, and then trying to actively either identify startups that address some of these, or working with startups in the future, or working with your portfolio companies in the future to sort of address some of these going forward.
Yeah, if I can just come in here, the
Yeah.
idea is of doing an investment thesis to build a very solid fundamentals based foundation for your own understanding of the space. So it's not about setting off enablers with challenges or one way or the other. It's about building an understanding that what are the driving forces, what are the obstacles. And as an entrepreneur, you know that part of our job as an entrepreneur is to solve the challenges and still come out as a winner, right? So once you have that understanding, hopefully it will help us understand when we are interacting with a startup, whether that startup can use some of the tailwinds and not get into the headwinds, right? And that still be able to make big. So it is thesis development is all about understanding, not about investment decisions per se.
Yeah.
Great, Shubham. I think there's a really good question in chat, and I think it goes back to the market size. Maybe you could spend like a minute on this. While calculating market size, we had assumed a RAS model, whereas in the
Yeah.
challenge is we are including capex investment and maintenance as part of consumer costs.
Sorry, while including, we had assumed RAS model, where in the challenges we are including capex investment. Sure. So for this particular sort of analysis that I did, so again, I think we did a couple of market sizing approaches, where we also took the number of robots that will be deployed, let's say over the next 10-year period. We took an average robot life of 5 years. Then we arrived at an annual deployment of robots, and the average selling price to arrive at a market size, and then that should be in the similar ballpark to RAS. If you go down that route, then the maintenance will be part of your consumer cost. But for the RAS model, the point is right, that the maintenance cost itself will not be part of for the consumer, but the ROI on the RAS price will still count if your robots break down and you are charging your consumer a fixed price. Then the payback period or the alpha that they would generate from deploying robots would be lower. Yeah, if there are no further questions, I think I will. So once the next step that we identified was that, and again this goes back to what are the funding trends in the market, and this becomes more important for an early stage fund such as ours, because uh, in later stage you need some growth of capital to be available, and for investors to be thinking fairly along the similar lines, for your portfolio companies to actually scale up. And so this is a fairly standard graph. What ideally it should show is that the market is not large enough where tens of billions of dollars have been deployed, which means that maybe as an early stage VC you are too late to the game. But it's not also in few $5 or $10 million, which means that there is no growth capital available for the portfolio companies. So as we can see from this graph, that over $1 billion have been deployed in the last 3 years. And actually in 2020, this is only for the first 9 months. Actually, it has already seen the number of dollars deployed is actually higher than any previous given year in the warehouse automation space, which gives us reasonable confidence that this trend will hold steady over the next 2 to 4 years, where we can expect some of our portfolio companies to break out and to actually go out and raise larger sums of capital from other institutional investors. I will just quickly cover the next slide as well, before taking any further questions. So this was whether there's capital available to build. And then, can you actually build a large company in this space? I think this is oftentimes this is while making an investment decision, investors maybe sort of overlook this. Um, this is extremely important in my view, because an ultimate goal of a VC is to obviously back innovation, but also to deliver a multiple on the capital that's been deployed. So if you are not delivering capital back to your investors, then as a VC you are not doing your job. So for us, I think we like to map the exit landscape or the acquisition landscape and see whether large outcomes are possible and who are the potential sort of players that are acquiring the companies, or are there enough IPOs happening? Is the are the public market supporting such businesses? We like to sort of spend some time in actually analyzing this as well. For the warehouse automation space, in our analysis, we realized about 20 plus exits have occurred in the last 8 years, which means that there is a steady stream of exits, but it has not reached a scale where a new player or a new startup cannot make a dent. And the exit value is total upwards of $5 billion. And as we saw in the last slide, the amount of capital deployed before let's say 2019 was only about $1 billion, which means that there has been a good return on multiple that's been shown by a lot of these startups. Uh, as you can see, there are a few common names that keep coming up. Amazon, which means that there is a lot of synergies that Amazon sees, and an Amazon could be a potential acquirer even if they won't be a customer. We can see Teradyne, who's again a large warehouse automation player, has existed for the better part of the last 15-20 years. They have made a lot of 200, 300, $400 million acquisitions. We see Shopify, again, they're trying to do a lot of provide a lot of services to their small merchant ecosystem, and they made a $450 million acquisition just last year. And then there was a $2 billion acquisition by a private equity fund called Thomas Lee Partners. I think this whole analysis on this particular slide should give you confidence that either there are potential acquirers out there in the market, or the public market landscape itself supports the exits of such businesses in the next 5 to 7 years. I will now take some questions, and then I think I will hand over to Roopan.
Shubham, I think we can take one question here in the interest of time. So there's a question that says, given that a few markets are winner take all, how does a market size of 1 billion give you a high enough return to cover for unsuccessful?
How does the market size of $1 billion give me for the winners, basically? Okay, understood. Yeah, so I think typically $1 billion annual market size means that $1 billion is being spent in the market. Let's say you reach a market share of 5 to 10%, which for most markets means that you're in the top 3, 4 players. You would have a revenue, as Manish also mentioned this number, a $50 to $100 million revenue company. Typically, in most startups, you can hope to receive a revenue multiple, and again, this would vary according to the space that you're looking at, but it could be somewhere between 8 to 10x. For SaaS businesses, it could be as high as 20-25x, and we are seeing for Zoom it's 40x right now. So if for a $50-60 million company, on the lower side, you should get a valuation of somewhere around $400 to $500 million. If it's a very capital efficient business that's growing at fantastic rates and is clearly the market leader, you can even get higher multiples. And then that's what you're looking at. You're looking at companies that can scale to at least $500 million in valuation within the next 5 to 7 years, to make up for all your other portfolio companies that might not scale to that level. I think that was that. I think I wanted to discuss the beginning of how we build an investment thesis. I will now hand it over to Roopan, who will actually go over the specifics on how we looked at different technologies and mapped out the space for the warehouse automation market. Roopan, on to you.
Thanks, Shubham. Can you just go back to the previous slide?
Sure.
Yeah. So great. Well, thanks for this. And so once we've already established the market opportunity that is there in any sector that we're looking at, we switch gears and look at what this space is all about. So in this section, the objective is to understand what is currently happening. What is the current landscape like? What are the kind of problems that are there in this sector, and what are the dynamics of this industry? So these are some of the questions that we will try to answer in this section. And the way to do this is, there are different approaches that can be taken up to understand or map out a space. For example, you could take a value chain kind of an approach wherein you try to understand what are the different kind of players that are involved in any specific sector, and try to see what the contribution of each one is. Or what you can do is also look at a user journey, and this is particularly pertinent if you're looking at an enterprise sector. So then you can see what a typical workflow for a user looks like and then map it out. So different ways of doing this. So now, even for warehouse automation, there's a certain way that we've looked at, but would be great to see if there are any ideas from the audience, if they have any idea what is a good approach to look at for mapping this space, understanding this space. If there are any ideas, any thoughts, please do comment here. Along the value chain. Great. Thanks, Ansh. If you see the logistics companies in India, they are fragmented and hardly make money. As you mentioned, all big e-commerce players has in-house robotics. How you see? All right, I'll address this later. Any other ideas? Okay. Shubham, can you move to the next slide, please? Yeah, so this is how we have approached this. So basically, you try to understand what an order fulfillment process looks like, and then you narrow down into the warehouse operations. So warehouse operations have different steps. So you ideally want to see what happens between the warehouse receiving a product and then the order, being shipped out. So if you see the slide, when the product comes in, it's in the receiving node, post which it is put away in the inventory. And once an order is placed by a customer, it is picked up, packaged, sorted based on the location it has to go to, and then finally shipped. So these are the different steps or the processes that happen in any warehouse. Next. So once you have the entire process mapped out, the next step is to understand what each of these steps entail. So how are people today trying to do this? What are the kind of metrics that are important? And what are the challenges across each of these steps? And when you do that, you try to, you get to understand what are the different problems. And in any sector, you'll find a lot of problems, right? But what is important is to understand which ones are the most impactful or high value problem. So in this case, if you see, after we've mapped out all the processes, we see that picking is almost 30-35% cost of the entire warehouse operations. Sorting also is almost 10 to 15%, which is also substantial. So, you can kind of narrow down that picking and sorting seem to be the high value problems to be looked at in this specific sector. Moving on. So once you've analyzed these things, you kind of understand what are the set of problems that the warehouse operations space encounters. So it's a very heavy on operations, as you can imagine. And today, if you see the way e-commerce is picking up, the way Amazon has set the standards for e-commerce, it's important for every logistics players, every e-commerce player to be able to deliver, to have a quick turnaround time for the customers, because that's what the expectation is. That's what the standard has been set. So you need to be able to have streamlined operations, efficient operations that can enable high velocity movement of the goods. And another thing is, of course, space efficiency. How do you get to do as much as possible from the same set of space? Because you have to pay the rent for the warehouse as well. And anywhere operations are involved, manpower is involved, there are a lot of inefficiencies. So wages are increasing. lot of challenges as far as the attrition or turnover of the manpower or labor is concerned. So these are, broad level problems that you get to understand once you've mapped out the space. Next slide. And in this process, you also understand what are the different dynamics of the industry. So in most of the industries you see, there are certain things which will be common, but you'll also find some unique parameters to look at specific to the industry that you're focusing on. For example, in warehouse automation, it's very important to see that the whole industry is driven by ROI. So you could be delivering any kind of automation process, any product, robot, fancy robot, innovation and all. But if it doesn't if it doesn't have a good payback period for the customer, if the ROI is not in the ballpark, then the customer will probably not adopt it. So these are certain traits that one needs to be cognizant of when you're analyzing the industry. It's important to see what are the decision makers, who are the decision makers, are they different from the end users of the product, what are the kind of dynamics there, what is the most appropriate GTM for this space. For example, in robotics overall, we see that direct sales is one of the channels, but it's very important to have good partners, channel partners to be able to get to scale. While in certain enterprise sectors, you see that community-led approach is the best approach, right? So different ways for GTM, and it's important to understand what a good GTM would look like for this industry. Likewise, a different other business model. We've already seen that in robotics, you have capex-led model as well as robotics as a service model. Also the subsector opportunities. Can this warehouse automation, is it applicable only to e-commerce? No, it is also applicable to, let's say, other FMCG or distribution-led products, right? So these are some of the things that one needs to keep in mind, understand the dynamics. And as an outcome, we will be able to understand what attributes a startup needs to be able to make a mark in this space. So, if any of you are going to attempt to do investment thesis in future, you'll see that, the approach, mapping up the space and all will really depend on the kind of sector you're looking at. Some of the spaces you'll find are going to be very intuitive. For example, I think warehouse automation, once you read a little bit, talk to a few people, is going to be easier to understand because you will be able to relate to it. But one thing to keep in mind is certain sectors actually become a little tricky. For example, someone who doesn't have the background in, let's say, biotech to be able to understand biotech or certain segments of healthcare can be a little challenging. So just be cognizant of this. So once we've established the market, we understand the space, we focus on the tech bit. And the idea here is to understand what is the existing technology that is in use in the sector, what are the kind of limitations that are there, and because of the limitations, you understand what are the gaps and what kind of solution will be able to fulfill these gaps, right? So that is the kind of objective of this section. Next slide, Shubham. So once you map out the space and everything, you do get an understanding of what are the different technologies that are being used in different warehouses, what is the cutting edge, what is probably the legacy system. You can always augment this understanding by looking at a few reports wherein sometimes you see people talking about what are the technology trends. So that also gives you a good idea about where the industry could be headed from a tech perspective, right? Next slide, Shubham. So here you see that, you on the leftmost side, you have the key technologies that are being used. Then you list down what are the limitations of each of these technologies and how, there could be certain solutions that can be looked at which can overcome these limitations. So instead of going over all of these technologies, I'll probably just take one example. So I'll take the example of sortation system. So typically in any warehouse, what you will see is once the order has been packaged, it has to be sent for shipping, and the shipping is one step before shipping is sorting. So in sorting, you take the package and then you put it in an appropriate bin depending on what the location is. So it could be sorted on the basis of pin code or some other method that the company could be using, right? So now today, the sortation systems that are in place mostly are these conveyor belt kind of systems where they take up a lot of space, are fixed systems, and need a very heavy upfront investment, right? Now, what we've seen is that over the last 1 year or so, there's a big push towards micro fulfillment centers in the warehouse space. What that means is that instead of having huge warehouses, there are many more smaller sorting centers or warehouses closer to the customer that are cropping up. Now, how do you take a sortation system which is huge and put it into space constrained centers, right? So that's a limitation that you can identify. Now, how do you overcome something like this? One option is that you have compact, small robots, set of robots that provide this functionality in a very small area, and they talk to each other to be able to route effectively, so that you can have increased throughput while having the flexibility and reducing the cost. So this is one of these. So this is one specific example of how you can kind of map out the technology, the limitations, and the possible solutions. Now, if you look at this slide, all the opportunity areas, once you look at, you can kind of map it to what are the opportunities for AI, right? So in our case, we tend to focus on AI applications. So each of these limitations can kind of give you an idea how AI can overcome these limitations. And we'll see how we can create a framework once we've identified these opportunity areas. So moving on, we've seen the market, we've seen the business side, we've seen the tech. Now, how do we combine it all, right? So first thing we look at is the winning attributes for the sector. And most of the sectors will probably have common attributes, but the metrics for each of these could vary. So in this case, economics is very important. We've discussed how ROI is important. Customers don't want any disruption to their operations. So that is also important, that how do you enable a solution without disrupting the flow. Technology, of course, look for differentiated and defensible technology. On the performance side, this could really vary depending on the sector. So for robots, it's very important to see reliable robots that have that are high on precision and have low footprint. Also on the team side, I think we've discussed quite a bit of this. So since we have understood the space, we know what it takes for a team to be able to succeed in this sector. So I would say domain background, someone who's good with, at least in the founding team, someone who's dealt with, let's say, robotics, if that's what you're keen on, or has been part of warehouse operations in some way, has the capability for global GTM, because we've seen already, Shubham has shown us that global market is very important for this sector. So if someone who can exhibit global GTM capability is the kind of trait that you need to look for. So these are some of the things that you kind of collect and cite as the winning attributes for the sector. All right, so next, what you do is you take a framework wherein you've identified all the AI opportunities. You put them in a in the top row, which is what all the opportunities that you would look at. And then on the in the first column, you see different evaluation parameters that you can look at to be able to rate each of these different technologies, right? So one important thing to look at is market potential, which is self-explanatory, that how deep do you think this market could be. Next is criticality. So we really need to differentiate what's good to have versus what is must-have. And this also shows a sense of urgency from the customer side, whether they are sitting and waiting for some solution like that, or this is something going to be good to have. So this will impact how quickly the solution is adopted, right? So next is application. So if you pick any of these, AI use cases, what you can what's interesting to see is, will that be applicable only to one use case, or over time it can be expanded to other use cases as well, right? So you look at the different applications of this of the AI. Next is to understand the impact timelines, which is, will it take 1 year for the customer to see the impact, or is it going to take 3 to 4 years? And of course, one would prefer sooner the better. Next is, how crowded is the space? So if you have too many well-funded big guys, then I think it's important to call it out. And if it's not crowded, then you probably mark it as green. Next is friction to adoption. So, like I mentioned earlier, in the case of warehouse operations, if you're going to provide a solution to the customer that would really disrupt their existing operations, and we are talking about warehouses where 15,000, 20,000 packages are being processed. So typically a customer would not want any kind of disruption, right? So that's why it becomes an important parameter. Lastly, control. So just to give you an example, so first thing, what control means is, how well are you connected with the customer? How do you have control over the relationship with the customer? So I'll take an example, which is the first example, which is computer vision and navigation. So essentially, if I'm providing a tech which is only the navigation stack, and it goes into a robot, which then goes to a customer, e-commerce player, right? So I am two step away from the end customer. But let's say if I'm developing the complete robot which has a navigation stack or rest of the other capabilities, then I'm just one step removed from the customer. So it's important to understand what the control dynamic is. So this way, this is something that we feel would be relevant for warehouse, but there could be some additional parameters also that could be looked at. So once you have this framework, you try to map each of these AI opportunities across these parameters and see which of the ones can be the most attractive. You will not find, I don't think it's practical to find something which is going to be like green across. So you will have a set of oranges or red, but what's important to see is that you have a good understanding of what could be high potential areas. So yeah, once that is done, I think what is important to do is you map out the entire startup landscape, and this needs to be done at a global as well as Indian level. So next slide. So this is not an exhaustive list, but we've looked at Indian companies that are in warehouse automation. We've morphed the names, but we've tried to map these startups across different parameters. And Shubham, can I request you to please open the Excel so that we can see the comparative landscape?
Sure. Just let me first. Is this slide visible?
No, can't see the Excel yet.
I have to stop share and then probably. Just give me 1 second. If there are any questions, feel free to.
Yeah, with every limited number of customers and the limited opportunity to build a moat, don't you think warehouse automation is almost getting saturated pretty soon? There's only so much improvisation that you can do. See, yeah, so that is why it is important to see what all are the subsectors, right? And we are actually not talking just about India, we're talking about global. If we are saying that e-commerce opportunity is stagnated, the existing warehouses are enough, no new warehouses are going to be set up, then yeah, then this would be applicable. But what we understand is this is a growing opportunity. More and more warehouses are going to be set up, and the trend is towards micro fulfillment centers. So you will need new technology which can actually be compact and be able to automate the whole process without increasing the cost. So there is always an opportunity. Will we get this presentation for reference? Yes, we'll upload this after the session. How important is it to have an in-house tech expert who has got his or her hands dirty in tech, given that such investments need strong tech defensive modes? So yeah, it is important. Having said that, it's not like you can't do without it. So it always helps that if you have tech expert, and this is something that we really pride ourselves on. So our team has operator experience. We've built products, and run companies, so we understand the tech angle. So it makes it easier for us to evaluate technology. But at the end of the day, I think what is more important is whether there is a curiosity to understand and break down the technology into subsectors, subparts, so that you have an intuitive feel for the technology. You don't have to go to code level or the mechanical level, but an overall understanding of what it entails, what is it that is going to be able to differentiate one from the other. I think that understanding is important. And if that is not there, then a lot of funds, of course, rely on either in-house experts or industry experts to provide that angle. And at this point, I would also recommend, if you are interested in understanding how one can actually do a tech deep dive, then we have a presentation which was done by Manish Singhal back, I think, in May. So if you go to our blog, you'll find that presentation where we have this framework which you can look at to analyze tech. I think we can come to valuation and all later on once we are done with this. So here, if you see, what we're trying to do is analyze different startups across certain categories. So once we have understood the space, we know what is relevant and what is important category that needs to be benchmarked. So in this case, of course, we look at funding because since we are early stage focused, we want to see startups that are relevant for us, and then we map it from application perspective, which is what all use cases can this startup cater to. So one is application. So we see startups that are looking at sorting, picking, or material handling. And some of them can, of course, be the tech stack, or they could be full stack, which means they're providing the entire robot. On the tech side, again, you can you can look at subcategories, wherein first you can look at what is the AI use case, whether the robot that is being built is fixed or mobile, or whether it's an AGV. AGV is automated guided vehicle, which needs certain trackers to be able to move, or is it an AMR, which is a mobile robot which can have natural navigation. You also want to see whether it's a cobot or not. So cobot means whether it's a collaborative robot which can work alongside humans. Finally, payload capacity, which is important because this will define what all sectors you can actually, subsectors you can actually target. So for e-commerce, something which is like 25, 30 kg is a very good number. But if you're targeting heavy industries, or if you're targeting industries where people use pallets, then you would need a higher payload capacity. Then we also look at business models, whether any specific startup has a global presence, the revenue, which is not always easy to find, but if it's available, it's a good number to see, and whether there are any key customers that the startups have. So this is how you map out the entire landscape as far as different startups is concerned. So just moving back to the presentation.
Roopan, meanwhile, I think there's a quick question.
Yeah,
How do you keep abreast of emerging areas and build depth both on technology and domain for you to be able to appreciate?
How do you keep abreast of emerging areas and build depth both on technology and domain? See, you can't build it for each and every industry, right? So in this case, when we started looking at warehouse automation, we went all in. And now once we have certain understanding of the space, we just follow what's going on in the industry and keep ourselves abreast of things. A lot of times you don't know about the technology. In that case, unfortunately, you have to start from scratch, right? You try to build an understanding by talking to people, learning about news, articles, what's happening, and also it's an iterative kind of a process. And even on the investment thesis, I think there was some question. What is advisable is that you create this investment thesis, but keep reviewing it every 6 months or so, because there will be certain evolution that will happen in the industry. For example, I think any investment thesis that was applicable pre-COVID, I'm sure has changed a lot, right? So it can either go up or go down. So it's an evolving process, and it's good to keep an eye on how things are evolving and keep updating it based on how things progress. So I
Roopan, if may I come in? So there was question about keeping abreast, and there was a question on Agnicool. So Agnicool was a bottom-up thing. We met a couple of space tech companies, got interested, understood the space, and then went and did the investment. And that is actually how sometimes you keep abreast of technology, because the opportunities that knock on your door forces you to go and understand what you don't understand or what you're not got exposed to. And over a period of time, you kind of, if you are meeting enough number of startups and doing your work on it, then you kind of over a period of time keep broadening your horizons.
So yeah, I think one final thing, just wrapping up the thesis before we go into Q&A mode. Uh, so you have the opportunities, you have the startups, and this is the starting point for you to now start deep diving into different startups. So investment thesis generally is a starting point before you go into the depth of any specific investment opportunity. But this is how you probably can narrow down the opportunities and see whether it makes sense to look at the space or not. So with that, I think we are done with our presentation and happy to take any questions. Why did we not consider payload capacity in market size estimation as well? So if you see, the market size estimation is mostly from e-commerce perspective, which is sort of like 15, 20 kg max. There are certain exceptions, of course, but 90% of the market payload capacity is in that range. So yeah. What is the relation between revenue and valuation of a startup? How does industry market multiple work? So, okay, if you're talking about early stage investment, there's not much of a relationship because most of the companies that we look at our stage are either pre-revenue or very early traction mode. So you really can't use multiples approach to something to value the company at this stage. So, in early stage investment, it's mostly driven by ownership. What is the kind of ownership that makes sense for a specific fund and stage? And that is all driven by fund economics. So, early stage, it's mostly, like I said, ownership driven. So, in later stage is when the multiples come into picture. In certain sectors, I think Shubham had already alluded to it, that in SaaS and all, you would see certain multiples which are kind of established. However, in certain sectors, that might not be the case.
Rupert, I think there's another question. Based on the thesis, how can we evaluate a startup building robotics?
So now uh, what a winning attribute, what are the set of winning attributes that a startup in this space needs to have. So you need to understand what kind of economics that they provide to the customer, what is their throughput, what is the cost of the robot, then how does the team look, right? What kind of capability do they have? Can they go take the company global? Do they understand robotics? Do they have exposure to the sectors that they're looking at? What is the performance of the robot, right? Apart from throughput, economics, and all that, is it robust? What is the kind of reliability? Those are some of the things that you would probably need to see to evaluate the startup. All right. What is it? Next question. Hmm. Extrapolating from Shubham's earlier thought about Shubham, can you take this?
Sorry, what was extra? No, Android is in the hardware space. What are the thoughts on customized service providers? For example, a drone startup which get how do you value it? Yeah, so I think uh, there is two parts to it. The valuation Rupan just spoke about. I think it is more of an art at early stage rather than a science. In terms of finding out the market size itself or the winning attributes, I think what we've realized in during our experience is that on day one, a startup will have one or two really strong use cases, even if they want to end up being a horizontal player. And it is okay to be a horizontal player or to be a platform. But on day one, you will eventually be catering to one or two really strong use cases. That is what we actually sort of focus on, whether the product or the technology can add value to that use case, to their starting beachhead market, and then take it from there. So early on, it is very difficult to look at a horizontal startup and say I will target all the sectors that exist in the market.
You look at physical tech ecosystem that the startups are in while looking to fund the startup, say cybersecurity in Israel while early stage investing. Um, Physical tech ecosystems.
I think the question here is, do we look globally, right, for competition and landscape? So
Yeah,
both
yeah.
of yeah, yeah,
Yes,
go ahead.
of course. Of course. See, we like to see startups or solutions that can be global in nature. So, and the idea is that, of course, you cater to India market, but you also cater to global market, and that's why it's important to map out the entire global space, not just Indian.
Cool. So for folks who are still interested in building an investment thesis and would like to do this on a regular basis, we have an exciting opportunity at the fund, a Pi Fellowship. We've got Akhilesh as well, who's also a current Pi Fellow. So it is a long-term paid fellowship. You will get to work on live deals with the investment head. You will build multiple theses. You will get to source deals. So you will get to learn the nuts and bolts of what entails a VC career. And we don't have any specific requirements apart from the fact that someone should be very curious, should be able to hustle, and should have good strong work ethic. And then finally, they need to have some passion about AI and deep tech, because that's the space we look at. We don't look for trivial use cases of technology, but something that can make a 10x differentiation to the market that they're targeting. If you're interested, we have a small assignment for you. If you There's an application, there's a Google form here on our blog page, and in that there are a couple of questions. The main exercise is that we request you to build an investment thesis on any one of the following topics that we've identified. As you can see, we've identified 7 topics. If you believe that you have much more value to add in some other topic, or would like to choose some other thesis topic, please feel free to drop me an email. We would still like to limit the topics to AI and deep tech. So again, more stronger use cases of technology. But as an opening stance, I think these 7 use cases is something that if most of you could pick one of these and then work on it. And the applications, so we have actually there are 2 weeks. So the applications close 2 weekends from now on the midnight of 31st October. Uh, and post that, we will be inviting a few candidates for a more detailed chat before we onboard them as Pi fellows. Happy to take any other questions about the fellowship opportunity as well, if folks might have that.
Yeah, there are a couple of other questions. The period of the fellowship is minimum 6 months, but it can be longer. What else we have here?
Time or part-time? The question on full-time or part-time? It's full-time.
Yeah.
I've already answered that. It's a full-time thing. We will make the form live shortly. We will fix the issue that Google form is showing up very soon. But please do remember that we are not entertaining an application without an investment thesis. So please do work on the investment thesis and then submit it. Compensation is it's like a stipend. We will based on your experience. We have 2-3 different levels. We will be happy to discuss that with you once the applications are complete. Yeah, the fellowship is Bangalore based, but everybody is working from remotely from home. So it's actually convenient if you're not in Bangalore.
Manish, I think there's some confusion in the chat with respect to the PI Fellows program and the PI Fellowship that we are opening currently. So could you just shed some light on that, please?
Yeah. So PI Fellows program is something we ran with a cohort few months back. Fellowship is basically an opportunity to work with the team for a longer term with us, right? So that's the idea. We do not have an EIR program right now, Sumit. And Shweta, what can I expect to learn through the fellowship? Everything that you need to do for a deep tech investment.
Manish, there's a question. Do you need to have 10 years of work experience to apply for this fellowship?
No. I think we have not kept a bar, but generally speaking, we are looking for someone slightly younger, maybe under 5 years, maybe 7 years experience, not too experienced as well. It's more for young professionals. Yes, there is a possibility of switching to a permanent role if things open up in the team. Absolutely.
Manish said if things work out and if there are openings, then we will make the person the fellow a full-time member of the investment team. However, people are free to also use this as a learning step and go out and either launch their own ventures or venture out into other things that they want to work on. What is the intake level? Manish, do you want to take that?
Intake level in the sense we are looking for one person. Is that what it is?
Yeah, I think so.
Yeah, if it is compensation related, it is as I said, it's a stipend, and then we do it based on the person's experience. And post completion, what role can you expect to get? It again depends upon your experience and how you do in the fellowship. We have several roles. We will place you accordingly. Like could be a analyst, it could be an associate, it could be a principal, it could be a VP, etc. I think there are some more questions. How many fellows will be selected? I think we probably will take one, maximum two, most likely one. So it's one position, guys. Do your best on the thesis, and that is the criteria mainly to select this. Are there any specific qualitative expectations from the thesis? It should just blow our mind away, isn't it? So I think it has to kind of be complete and has to do justice to the topic, just like Shubham and Roopan have walked you through on how do we do a thesis, what are the different elements of it, and we will post this presentation also for you to refer to in case. And in case you have a doubt, just feel free to ping any one of us. Our email IDs are out there, and we can answer those questions later also.
Does it have to be India-centric for the thesis?
I think global, yeah.
The joining.
I think we will work that out. I think we want, obviously, I think we have given I think end of the October as the last day. So maybe another 10-15 days to evaluate everything. Then as soon as you can join after that. Oh, expected to June 21. Yeah, that may be a bit too late. That's almost like 8, 9 months away. Yeah, not. Can we look at sponsoring one more fellowship, working with you guys on robotics in semicon? All right, we can. We always welcome money, so please let's just drop any of us a line. We will, Muthu, we can talk separately on this. Like to understand how do we evaluate the companies building core technologies and are IP driven for product? Yeah, that's a good question actually. So the question is that if there is a company which is more IP driven than product driven, then how do we evaluate it? I think I'm just trying to think. I think probably Niramai comes closest to when we invested. They basically had a bunch of algorithms and IP which could be used for breast cancer analysis. They did not have a product. So how did we go about doing it? See, I think ultimately you have to envision what product that IP can translate into and what is the market that it can address. So based on that evaluation, you go about backing that company. You do not back a company just because the IP is good. I think unless you can see a path to the market and the market size being there and the need being there and all the other elements and Shubham and Roopan have talked about, you typically don't go and invest in IP just for the sake of it. All right, I think Shubham, Roopan, what's next now? I think I don't think more questions are coming. So.
Sure. I think the access on the forms has been fixed. On the blog as well, you have my details. So if you want to discuss some other topic, feel free to drop me a line. Otherwise, we hope to receive applications from at least some of you, and would like to then get to have more one-on-one chat with you guys. And unless there are any other further questions, I think we are right on time. Thank you all again for joining. This has been a pleasure, and we'll be doing many more sessions in the future. So hope to see you guys there as well. Uh, Take care.
Thank you.
Thank you.